what is payment processing? Again, you might be brand new to the industry or an industry veteran, but how do we go about explaining this concept quickly in just a few seconds to explain what payment processing is? Well, ultimately, payment processing is moving money from a consumer's bank account to a business owner's bank account electronically. Now, there are obviously a lot of steps in the middle. The money doesn't flow directly to the business owner. It's going to flow through credit card processing companies and banks, and the card brands are involved like Visa and MasterCard. But ultimately, at the end of the day, a business owner has something that they're selling. A consumer or a client wants to purchase that item. And so the business owner needs to get the money from the consumer's bank account to their bank account as inexpensively as possible. Now, it's interesting actually when you think about this industry because, 100 years ago, nobody was using credit cards, of course, right? Everybody was using, checks and cash and things like that. They maybe would have a credit account at a store and very unorganized credit accounts and things like that. And so when credit card processing came into the picture and credit cards came into the picture, that whole model was really predicated on merchants paying fees. And what happened initially is we've all had this experience, right, where we've walked into a Walmart or a Target and all we need to do is buy a gallon of milk and maybe a loaf of bread, right? Where do they put the milk? Where do they put the eggs, right? Do they put it right up front in a little cooler so you can grab it and walk right out the door again? No, they put it in the very back of the store. Why do they do that? Because they want you to walk all the way through the store to see all the flat screen TVs that are on sale and the clothes that are on sale and the other food items that are on sale because they want you to buy more stuff, right? And so 100 years ago, when retailers would try to use these strategies to get consumers to buy extra things, they realized very quickly that it just didn't work because consumers only had, maybe they brought $5 in cash to go buy that, milk. In today's money, maybe we brought $3 or $4. So we go and buy the milk. Well, we see a flat screen TV we want that's $400, but we can't buy it because we only have this cash on us. And so initially this idea of a network where consumers could easily gain access to their own funds through a debit card, through their bank account, or using a credit card, they could gain access to somebody else's money they can spend, the bank's money. It allowed businesses to dramatically increase revenue because they can increase the average transaction size. In other words, when I go into Walmart to buy that gallon of milk now and I have my credit card with me and I see that flat screen TV for $400 on sale that I want to buy, but I really just came for the gallon of milk, all of a sudden now I can put that flat screen TV in my cart because I know when I get to the counter, even though I don't have enough cash to pay for it, I can pull out that trusty credit card and I can buy whatever I want as long as it's within my credit limit. So when we say what is payment processing, we have to understand that initially, payment processing was really designed to give consumers ready access to their money and also to then give business owners the ability to get consumers to spend more money, okay? So it was a great win-win scenario. But here's where the rub comes in, and this is where cash discounting comes into the picture. Somebody has to pay the cost of moving this money around. Now, initially, it was actually very costly for the banks and the card brands like Visa to move money around. Some of you may have seen pictures or experienced the, knuckle busters, they called them, but these slips where you'd have a credit card and then you'd have to actually use a carbon copy and do a paper version of this receipt. And then this receipt got sent in and, hey, this got sent to Visa and here's money that's owed. And, all of these old technologies and paper-based technologies, it was very expensive to process credit card payments. And so the banks and the card brands understood this, and so they had to charge fees. They couldn't just move the money for free. They wanted to make money, but they also had to cover their cost. So they were charging fees in order for this to happen. So who is going to pay that fee? Is the customer going to pay it, or is the business owner going to pay it? Well, the interesting thing is that early on, when it was a brand new concept, it was actually the business owners that benefited significantly more than the consumer. because the business owners were getting all this extra revenue by people being able to have access to money. And it was really a great idea for businesses to accept cards. So they were paying a fee for any money that was, spent in their store, because they recognized that, if it wasn't for this Visa credit card company, I wouldn't be making this sale. So I'm happy to give up 3 or 4% of it and pay fees in order to get this money that I otherwise would not have gotten. And so early on, 40 years ago, 50 years ago, that was the way it all worked. And it kind of made sense because, the business owner would pay the fees. So Visa didn't want the consumer to pay the fees, because consumers were still getting used to this idea. And for the consumer, they were actually spending more money oftentimes than they realized they were going to spend. So for them, it was more of a, hey, they're paying interest on the credit card already. And so all these other things came into play, and it made a lot more sense initially for the business owner to pay the fees of moving this money around. So ultimately, when a transaction is processed and that money moves from the consumer's bank account to the merchant's bank account, those two institutions are called the issuing bank and the acquiring bank. And as that money moves over, there's actually a percentage of that money that's actually held by the issuing bank. And so there is a cost. If you go into a business right now and you use your credit card to spend $100, that business owner is not going to get $100 if they're not on a cash discount program. They're probably only going to get $96 or $97, because once they get done having the fees taken out for the bank, having fees taken out for the processing company, and having all these other fees from the card brands, all these other things that these costs are coming out, that $100 suddenly becomes $96 or $97. And so what's happening with payment processing is that businesses are finally starting to say, wait a second, it's not 40, 50 years ago anymore, okay? We actually don't need this. This is something that consumers are actually getting a much bigger benefit for than the business owners are anymore. Consumers love using credit cards, right? They love having access to their money. They love getting reward points. They love getting frequent flyer miles. They love all the conveniences and the fraud protection and the security and all the things that go into using electronic forms of payment. Consumers love it. And all of a sudden, many businesses, the vast majority of businesses today, actually get more credit card payments than they do cash payments. And so they're getting all of these credit card payments because consumers now want to use the cards. And so what's happened is this value proposition has kind of flipped. And all of a sudden, many business owners say, you know what? We don't mind if somebody wants to pay cash. That's fine. We know that they have debit cards on them. They have credit cards on them. They have multiple ways to pay. They could choose whatever method they want. And we're at a point where it's actually the consumers that are valuing this ability to use the card more than the merchants value the ability for the consumer to be able to use the card. And so all of a sudden, the merchants and the business owners are saying, why are we paying a fee to get somebody's money? Not to mention, is it really that expensive anymore to move money electronically? Should we really be paying 3%, 4% of our revenue to another company so they can electronically move money from one account to another? That's a lot of money to spend, And so business owners in the US especially are really starting to bucket this and say, wait a minute, something's not right. The cost of accepting credit cards keeps going up, up, up. The actual cost that the banks are paying in order to move this money around is probably going down and down. Why are our costs keep going up? And it's time for small business owners to say no to that and to shift that burden over to the consumers that are actually getting the benefit. Now, we're going to dive a lot more into this and talk about why it's also a good thing for the consumer. But answering this question of what is payment processing, ultimately, we're moving money from the consumer's account over to the business owner's account, and the business owner wants that to happen as inexpensively as possible, and it does not get any less expensive than cash discounting, which we're going to describe more in the next few videos.